Hello everyone, and welcome to your Masters in Management. My name is Sandy, and today we'll be discussing Module 5, which is about financial management. Today we're here with Mr. Spiteri, who will be sharing his knowledge and expertise on the topic. Mr. Spiteri, thank you for joining us today.
Thank you.
So, my first introductory question is, what is finance all about?
Well, finance is a very particular and very important part of any organization, be it in the private, be it in the public, be it an NGO, and what have you. It is a very important resource, and it has to be managed like any other resource. Mm-hmm. Now, it's very important to keep in mind that the finance function has mainly two different areas. One is the utilization of the resources that they have, but also the management of resources, in particular financial resources. Having adequate finance is a very important thing. And when we say adequate, people might think that having finance is the best thing in the world, and that if you have that, you have the adequate amount of capacity to grow and to make your plan worthwhile. But actual fact, it's like any other thing that you have to do and manage. It has to be managed appropriately. Now, again, this is, and I said two very important areas, is the accumulation of the appropriate level of finance and the management. Now, when you talk about the appropriate amount of finance, is that you have to understand that what your objectives are, what are the plan, what is the strategic orientation of the organization, because that will indicate what you need. It is like building like a building block, or like you're building a building. You need to have a very good understanding of what the scope is, what you intend to do, how long it will take you, and time is also a very important thing. So timing of finance is also a very important aspect as well.
Okay, great. Could you explain the broad aspects of financial statements? So what are they all about? What do they represent?
Okay. Again, it goes from the strategic orientation of the organization. If you look at the organization, how it intends to move forward, financial statements in themselves assist in the planning, the monitoring, and the evaluation. So financial statements have been around, in the way we know them, for a relatively short period of time. If you go back in history, we're talking about 1971, 72, where we have a further evolution of financial statements. And the important aspect is the standardization of financial statements. But if you go back in history, you will find that the need to have financial information and information relating to finance has always been with us. We can go back to the Mesopotamian era, which is around 2800 BC. So the importance of monitoring and evaluating and keeping a record has always been around with us. Even on a personal level, from a financial perspective, we also want to know where we are, how much, what we are on a financial level, what we require, and whether we can attain that, and what we have to do to attain that. Mm-hmm. So again, it's about planning, it's about monitoring. And the financial statements in themselves represent a standardized method of presenting that information. So it's a fundamental aspect about monitoring and managing your organization. It's very important that we talk about standardization. You can create any type of financial information about your organization. In fact, there are two broad areas of accountancy, which are very important to keep in mind at this point. Because there's the point of financial management and there's managerial accounting. And why am I distinguishing this? Because there are two different roles that are required. While the financial management is a more of a, legalistic requirement and a more organized and structured in a manner that is legally required, management accounting, on the other hand, is much more about going into the scientific aspect of finance, of analyzing costs at a very minimal level. They're very important, and one joins up with the other. But we also have to keep in mind in the purpose of the two different realms. Financial statements are crucial because they also report and they also evaluate and represent different areas of evaluation. In the normal set of financial statements, you will find you'll find the statement of financial position, which is previously known as the balance sheet, which represents a snapshot of the financial position of an organization at a point in time. So when we talk about that, we're looking at the breakup and the composition of the assets and liabilities, but also the shareholders' equity position within the organization. What I just mentioned is a very important equation which will always transcend into any type of argument or any type of discussion in evaluating financial statements. It is what we call the accounting equation. Okay. Now, in the assets, we have long-term and short-term assets. What are these? These are claims that the organization has on assets or on claims on other entities as well. So you will have the situation where you have non-current assets such as buildings, like vehicles. These type of assets are assets that remain within the organization for more than one financial year. And on the other hand, the short-term assets are those type of assets that will be converted into cash or cash equivalents within one financial year. Now, you can have a long-term debtor, for example, which over 2 years would be a part of its long-term assets. But as it enters into the last year of its meeting its obligation, it will fall within the current assets. On the other hand, you have your liabilities, because again, like if an organization has a claim on assets, it also has an obligation to honor its obligations to other parties. So liability is an obligation to honor its obligations with that organization. And again, you do have short-term and you have long-term liabilities. Okay. Within the liabilities spheres, you will have borrowings, you will have prepayments from customers, you will have many different categories of claims that other entities have on the organization. The last part of the accounting equation, which is a very important part of the statement of financial position, is the equity position. So when you look at the balance sheet, and that's why I'm going to say balance sheet, because it's very important to give a visual to what I'm saying. Mm-hmm. When you deduct assets minus liabilities, you are left with what the shareholders have on a claim on the organization as a whole. So if you have the situation where a company is making profit, the value of its assets are going up, obviously, and your liabilities remain within the same level, the residual balance will be the amount of contribution that the shareholders would have given, plus any profits or reserves linked with that organization. So just to give a perspective, this is the standard general way of presenting a statement of profit of financial position. The other very important statement is a statement of financial performance, which is in previous versions of accountancy, it would be called as the P&L, or the profit and loss, or the income statement. Now, what does the P&L represent? The P&L represent, or the statement of financial performance, is the evaluation of how well an organization has done during a particular financial period under evaluation. So you would have your revenue and you will have your expenses, which will be matched against each other to see if the company has made any profit or loss. In a non-profit organization, it would be slightly different. Again, you do have inflows of money coming from donations and other matters of that sort. But again, you would also have expenses. It doesn't mean that just because a non-governmental organization or non-profit organization is operating, it doesn't mean that they don't have a residual balance at the end of the year. So we have to keep this in mind as well. Again, it's not, let's put it this way, people might not expect this to happen, but actually it's a very good thing. Why? Because when you see an organization making a profit or a surplus, it's showing that the management of the organization are meeting its objectives, but also not only meeting its objectives, it's also making a profit or having a residual balance within their statements. The last statement I want to talk about at this stage is the statement of cash flows, which many people get a little bit confused about this because it's not something which, let's say, investment houses talk about. Cash flows. It's not something which is widely spoken, but it's actually very fundamental from an organizational perspective. Why am I saying this? Because you can have a business which is making a lot of profit, or could have a high level of assets, but it's not generating enough cash flow to operate. Think of the cash flow as the bloodstream within a body. Okay. Now, if you don't have the right amount of money flowing inside and outside of the organization, the organization might not be in a position to honor its obligations. So it's a fundamental issue. And the statement of cash flow definitely shows how the cash is being administered. It's both from an inflow perspective, but also from an outflow perspective. And there's a slight difference between what is reported in the financial statements to what is reported in the cash flow statements. But again, at the end of the day, we are looking purely at cash transactions. And it's a fundamental thing, as I said. You don't have enough cash resources, you will not reach your obligations, and it will also mean that you might become illiquid. Now, the term cash and liquidity within an organization is fundamental.
Okay, thanks for that. And next, how do we use financial statements? So, for instance, what are ratios and what are their significance? And how could we use it in the decision-making process?
This is a very, very important question here because, again, it's like having a tool, but not knowing how to use that tool. Okay. If you have a set of financial statements, you have to know how to interpret them. But more importantly, from whoever is reading those statements, they have to understand what they require from it, like any other tool, and any type of information as well. Basing your decisions, you have to know what you have to look at. And as I said, given that we are talking about standardized documents which are legally bound to be presented by all limited liability companies and also by listed companies, in that way, the first point of reference is given that they're standardized, they can be comparable and they can be interpreted easily. It's a fundamental issue here. Now, the second thing is that looking at the numbers on their own might give you a very limited perspective of how well or how healthy an organization is. So then comes what we refer to the ratio analysis part, which are crucial because, again, what you're doing there is you're dissecting that information to reach to the objective of what your analysis is. Now, ratios in themselves are not extremely difficult to calculate because what they are simply is comparing numbers with each other or getting a percentage or getting a relationship between one part of the statements or not. So what we're talking about here is a series of numbers, but the most important thing is not just the numbers themselves, but it's the interpretation. Now, understanding what the ratios are implied is a crucial thing and what you're looking for. Again, ratio analysis is split up into different categories. And again, while the standard series of ratios are very standard and very formalized, and a lot of accountants and financial people know what we're looking at, it doesn't mean that they're applicable for all organizations because you have to understand what type of business you're talking about. For example, if you're talking about a retail chain, it's very important to understand how important it is to manage your working capital. For the benefit of the people who might not understand what working capital is, it's the relationship between its current assets and its current liabilities. Now, if you have to have the right mix. Now, evaluating, say, for example, current ratio or an asset test ratio will demonstrate how capable that organization is to meet its obligations. And as I pointed out in the previous question, this is a crucial aspect because if you're not capable of honoring your obligations, you will not be creditworthy. Banks will not provide finance to you, and your business will not be doing well. I mean, there will be a short time before nobody starts trusting you. So understand that the ratio in itself is an indicator. It's a yardstick or a measurement to evaluate how well an organization is doing. There are many, many different aspects of what we look into. And by the way, ratio analysis can go, and somebody can invent a ratio because you're looking at a particular point in those financial statements. But that's the beauty of it. But again, the problem with ratio analysis is that you're always looking at previous information. The important thing, if you're looking at it forward-looking, you have to be capable to interpret how well organized the strategy and the implementation of that strategy comes into play.
Okay, thanks for that. Next, I'd like to ask you, what is budgeting all about?
Well, again, we just talked about the importance of management. We talked about the importance of gauging an organization. And as I just pointed out, looking forward, an organization has to be capable of managing its resources. As I said in the first question, referred to the first question that you mentioned, is that in order to project where you want to go and implement the strategy and the plan that you have to have a financial plan. Because again, reaching out and saying you want to increase sales by 20% or want to expand your operations into a different country, you have to understand the financial resources and obligations that you might have to incur to reach that objective. Fundamentally, it's just numbers interpreting a plan. But the most important thing is that whoever is doing that plan, whoever is drawing up that plan and considering all the different elements, has to have a very good understanding of what's going on. So the number part and the presentation of the budget in itself is relatively the easy part. The most important part is the understanding of the strategy. Now, the budget in itself is a series of different, processes which results into a series of documents. I'm saying a series of documents because when you talk at the master budget, in that master budget, it goes down and filters into the different areas of operation of this organization. Now, it's one thing having a small corner shop, which is doing a budget for the previous year. It's another talking about a large governmental organization or a pan-international organization where you go into foreign currency, where you go into risk evaluation, where you talk about the probabilities of occurrence, giving some leeway in the budgeting process. Because again, as you can presumably understand here, when we talk about budgeting, you might look at it in a very rigid perspective. And usually that's not the right way. You can only think about that if you are definitely 100% sure about the assumptions that you're making. But in today's world, how the dynamics and the environment that we work in, it's very difficult to actually pinpoint all the criteria in reaching the objective. So it's very important to keep in mind that that things change and there needs to be leeway in your budgeting process.
Okay. Yes. All right. My next question is about risk analysis and project evaluation. To start off with, what is risk, and is it all bad for management?
Well, risk is relatively a negative word. People connotate it with doubt, with uncertainty. But in today's world, if you have to really look at the way we live, how organizations operate, risk is always with us. You can never do away with it. And it's through history, you will realize how important it is to manage risk in the most appropriate way, because things change, the environment changes, strategy of an organization changes, and it has to adapt to it. Now, risk and risk management are become a fundamental aspect in all organizations, be it in the financial sector, be it in government organizations, because again, the uncertainty associated with risk has serious repercussions on the performance of an organization. And I'm saying performance because I want to point something out to you, Sandy. Mm-hmm. The thing is that not being in being a profit organization in itself doesn't mean that you can do away with saying and shrugging off the aspect of appropriate risk management. Because again, everybody has limited resources, everybody has to reach their objectives, and you have to reach that in the most efficient way. Mm-hmm. So risk management is a fundamental part of the whole management process. Okay. Now, in any type of decision making, especially if you're growing your business, if you're expanding your operation, be it in the private or the public sector, the appropriate allocation of resources to different initiatives is crucial. Now, with project management, again, this is the culmination of what I'm just talking about. Mm-hmm. Having the adequate understanding, the adequate approach, the adequate elements of evaluation comes into play. And with investment appraisals, for example, an organization will have to go into the specifics of a particular project or a series of projects to choose which one of these projects are the best, and given that within the limitations or the method of evaluation. It's a very important part that I think that I would like to say at this point, okay, is that in a project evaluation, the criteria might not always be the right aspects to do it when you talk about that in the future. Why? Because as I just pointed out, the future changes. Mm-hmm. So you have to be capable of creating a situation which changes over time. But again, the evaluation process is fundamental. Now, when we talk about project evaluation and investment appraisal, what we have here is we have two different schools of thought. One of them is what we call the more traditional method of calculation, which looks at profit particularly, where we talk about payback period, for example, which quite interestingly is very straightforward. Payback period is about I've put money into a project, which one will return money to me in full within the shortest period of time. Now, in itself, it's very relatively simplistic, but at the same time, it's fundamentally crucial. Why? Because a very scientific aspect of finance is about the time value of money and risk associated with the length of time before we recuperate our proceeds in investment. And payback period, which is one of the most earliest, most simplistic ways of evaluation, is what they do, what is done. Because you're looking, saying, if I'm investing, say, 100,000 in a project, which one will assist me in recuperating that 100,000 within the shortest period of time? In the accounting rate of return, we're taking that to a different level. What we're doing is we're taking a similar philosophy there about looking at the less time it takes to repay, but you're also introducing accountancy principles such as depreciation. You're looking at expenses. You're looking at number of different aspects which come into the residual balance of an investment and the profitability that project does present. The other school of thought is where you're looking at discounted cash flow methodologies. Now, this is where risk and risk management comes into play in this evaluation. Why? It's because, as I've just pointed out, a very important thing is about the risk aspect of the financial resources linked with that project. Now, when we talk about risk, we're talking about the probability of uncertainty. So when something is more uncertain, the risk associated with it is higher. So when you discount your cash flows and the project is higher risk, carries a higher risk, what you're doing is that you're discounting future cash flows at a higher rate. So again, if you had to be a bank, let's give you a simple example here, and you have two different proposals in front of you, very similar in principle, but one person has a lot of experience and the other one has less experience. Now, the probability that the person that has experience obviously will give you a sufficient amount of track record that this person will reach that objective. So the discounting part of that project might have a lower rate of discounting. On the other hand, the new person in the field who might not have experience or might not have the right setup will have to incur a certain amount of, let's say, opportunity costs to weigh further the possibility that this project will not work out. You know, to be honest with you, if you have to look at it from a practical perspective, it's not always fair, because it could be that the new person comes up with more innovative ideas, is more attuned to the present environment and the new technological developments. If we talk about Pastel, he might be more, or she might be more, conversant with what's going on. But in theory, that's what happens. That's how it goes. Unfortunately.
So, could you amplify a bit further about risk and the implications for management?
As I pointed out before, risk management and identifying the different aspects of risk have become much more evident in today's world. Today's world has become much more complicated. The interaction within different elements have added, a complete different environment within which people within an organization, any organization, have to manage with. Now, it's very important that there are, as I pointed out in the previous question, that there are firm-specific risks. So what we're talking about, this is much more internal, and it's all about how an organization is administered. So what we have here is we have diversifiable risks and undiversifiable risks. Now, what do I talk about? Why am I making this distinction here? Because effectively, management can control uncertainty. Why? I'll give a simple example. if an organization was doing a process, for example, and they're noticing that they have increased wastage, that in itself is risk. Why? Because you might have planned to obtain a certain level of efficiency, but you're not managing that appropriately. So again, risk management. You're talking uncertainty and how it's being managed appropriately. So what we're talking about here when we talk about diversifiable risks are those risks that from a managerial perspective can be handled. So another dimension which I can talk about is the likelihood of undesirable situations. For example, floods. For example, disputes with unions, uncertainty regarding suppliers, uncertainty regarding lawsuits. These can always be contained in one way or another. And why am I saying this? Because it depends on what risk appetite that the organization dictates within its overall strategy. So you can have a situation where, given that the industry as a whole has risk, its risk has increased significantly, one way of handling this risk is could either divest itself from that area, from that business, but it can also include insurance coverage. It can also reorganize itself. So this is much more within the control of the organization. The systemic risk, which is much more of a macro perspective, is that risk that the organization cannot control adequately. So that you'll have to live. The organization has to be able to manage and even take opportunity to get in favor of itself to manage accordingly. Again, I have to emphasize the importance of the skill set within the organization. And in the past, I can mention a number of different situations where certain well-known brand names have died away because of the lack of appreciation of the risk environment that they're operating in.
Great. All right. Well, thank you for that.
Okay.
Very good.
Yes.
Did you want to add anything else?
Yes.
Sorry? 3 minutes. Okay.
You want something else? Okay. yes, I have one. I can say something else.
Do you have maybe another 3 minutes?
Yes.
That way we would
Definitely. I
40
definitely can talk about, because I sort of stopped there and you sort of stopped.
Oh, you didn't finish?
No, I was about to say
sorry.
financial risk management, but yes. Okay. Sorry about this. Is
My
this
bad.
normal?
No.
Because last time it was
we've gone short
Yes.
a number of times. Yeah.
Okay. I'm gonna.
I'll start on Sunday. We're gonna shout through.
I can continue. I can just continue.
Sorry, I didn't
Okay.
realize.
No worries. We misinterpreted each other. Okay. Now, another very, very important thing is how this risk is managed. Now, when we look at risk from a financial perspective, and it's very important that I point this out at this stage, is that from a financial perspective, organizations can be affected by a number of different financial aspects. For example, commodity prices. Okay. If you have a situation where an organization is highly linked with, say, oil prices, that has something that has to be high on the agenda, because it's these elements that will affect significantly and have a bearing towards the effective performance of an organization and how well an organization is managed and administered. Another very important thing is, say, volatility in cash flow cycles, for example. And again, it's understanding the business and what is pushing forward. How is it being managed and conditioned? So I can give an example there. Just say that you are in the auto import industry, for example. And at this stage, you know that if you're importing a certain amount of cars, which are normally normal combustion engines, and you know that over the next 5 years, that type of demand will no longer be required, you're going to be exposed to foreign exchange risk, especially if you're importing stuff, vehicles from outside of the EU. If you're EU based, you will also be affected by demand because you are allocating resources to stock which is not being affected. So again, it comes back to understanding the risk implications of any different decision that is being taken. Also, you have to understand that when you're administrating the costs, you also have to understand the opportunity cost of being capable of managing those risks, because it's not that straightforward to completely control it But you also have to understand that, say, if I'm going to be able to manage it, say you have a pending law case, for example, how capable will you be to sustain a legal battle in court and sustain those expenses, and not only be open to further risk that could even hamper other areas of your operation. So these are crucial things. So, if you had to say that financial risk management is easy to maintain, it's not always that easy, and it's not always easy to define, because there are many different facets to it, and the implications could vary from very insignificant to very significant based on the circumstances that you are in. And it's very important to keep in mind that not every organization, even within the same industry, might not be affected in the same way, because again, it's a composition of an organization and how well it's administrating and effectively using those assets.
And for my last question today, I'd like to ask you, why is it important to understand risk?
Well, I just pointed that out to you in the previous question, but it's a very important thing that we emphasize the point here. Risk in itself is not something negative. I mean, it's a very common thing. But if you understand how the financial markets work, if you had to evaluate exactly what happens, it's about risk management. It's about identifying opportunities at points in time. And it is always there. You can never do away with it. So risk management in itself is a crucial thing. Now, we have to keep in mind that there are two different broad aspects of risk management. One of them is linked with the particular company, with a particular situation or entity. But there's also risk management perspective, which talks about the environment within which you're operating. So think about macro and micro environments here, and how risk changes between both situations. Now, from a planning perspective, understanding the environment and understanding what will affect that organization in a different way is crucial. You can't control it. An organization will not be able to control the macro picture, no matter how big you are in the operation, okay? The micro aspect of risk management is much more internal. And it's very important that from an internal perspective, they understand they have the right strategy, they have the right structure, the right skills. Unfortunately, we're talking about finance here, but it's very important that the people who are at the helm of an organization have the right competencies, because usually, historically and statistically, it's proven that no matter who you have at the administrative level of an organization, if they don't have the right skill set, you're in a very good probability that it will not work out well.
Okay, all right. Well, that concludes the questions I have for you today, Mr. Spiteri. I'd like to thank you for your time with us.
It's a pleasure speaking to you.
Great.
Thank you.
So there you have it. Today we spoke about financial management, and our key topics included the definition of finance. We looked into financial statements, what they represent and their use. We looked into budgeting, and lastly, we looked into risk management. That's it for today. Thank you, and see you next time.